data to core sector growth to auto sales numbers to jobs data, well, finding positive news on the economy is a tough task nowadays. Most indicators point to a slowdown of some sorts, but how big is the problem? Is the economy truly heading towards dire straits? If not, then can the indications coming in from data be ignored? And can a rate cut, as is being widely hoped for this week from the RBI, going to be enough? To speak on all of these key questions, I'm joined this evening by R. Gopalan, former DEA and Finance Secretary, Shogota Bhattacharya, Chief Economist at Axis Bank, and Maithili Bhusnamarth, Consulting Editor, ET Now. Welcome to all of you and thank you for speaking with us. Mr. Gopalan, let me begin by asking you, is it really that bad or how bad is it?
Okay, it is really bad, I would say, but there is no reason to worry. We always have a way of, getting back. Look, this is a function of a number of things which have happened in the past due to world economy slowing down, our own, agriculture, inflation being very, very low, and there are different economists look at it in a different way as to how that can be interpreted. The jobs have really, slowed down, but there are ways to, get it up, and it's not a not going to be something dramatic. It's a long haul, but we have got to sensibly go about doing it, and that's the best thing the government can do, which has such a massive mandate, and therefore they should be in a position to make the necessary reforms that are required to be brought in.
Absolutely. I asked an open generic question, Shogota, so let me come to you with that as well. You know, the key data points that we're talking about, which have come in the last few days, we spoke a bit about it, of course, right here on this show when the GDP numbers came out. But are the overall trends, when you add things like Maruti sales drop, worse in 7 years, biggest drop in 7 years, you add things like consumer durable companies looking at drop in demand. What is the overall picture and how clearly, cloudy does that overall picture look to you?
So a couple of things. I think about a month or so back, it was looking pretty bad. Even now, I think the slowdown is continuing. As you mentioned, automobile sales, etc. But we are seeing some signs of positive movements. You've seen some of the two-wheeler vehicle sales having recovered in the month of May. Automobile sales, commercial vehicle sales, everything, the rest of it is still down. We are also hearing word, and you are seeing some part of that in the Q4 results, that consumer durable companies, some demand for a lower ticket consumer durables are slowly beginning to revive. So while, the net result of all of this is that there was a fairly significant slowdown in the months of February, March, April, something carrying on to May, but we are beginning to see some signs of gradual revival.
Okay, let me come to you then on all of these expectations from the rate cut, and let me come to Shogota first. There seems to be this clamor that, of course, the Reserve Bank will have to, cut rates. 25 to 35 basis points are being touted about. But how much is that going to help?
So a couple of things. I agree with you that our own view is that somewhere between 25 and 50 basis points is probably the likely rate cut outcome that will happen. In itself, the rate cuts will not probably do too much beyond increasing the level of confidence of some of the policymakers, some of the stakeholders, etc. So its monetary policy in itself will not just be the rate cut. I'm sure together with the rate cuts, there will be more measures to provide liquidity in the system. In the SPDR statements that comes in with the monetary policy, you will have other measures to try to increase credit flow, overall flows of credit into some segments, particularly NBFCs that we look at. And then with this monetary policy, then you are beginning to see in the next month, early next month, the budget that will come in, what kind of fiscal, limited as it may be, what kind of fiscal stimulus comes in. Then we are seeing the trade policies come into play. You are going to see some labor, industrial policies, etc. So, but you have to take this in phases. So the first part obviously will be to try to lower the cost of funds, particularly for borrowing for consumer durables, automobiles, etc. Overall cost of borrowings, but this has to be done in phases.
Well, Mr. Gopalan, let me come to you with all of this, huge emphasis on what the Reserve Bank will do. A lot of times, and we've seen this time and again, governments of the day try and put quite a fair bit of onus on the Reserve Bank, that now you have slowing growth, you must cut rates. Meanwhile, inflation is not looking very comfortable either. Do you think that there is too much hope being put in that 25, 35 or 50 basis point cut if it comes about?
As Saugata mentioned, mere cutting of rates is not necessary. It will be sufficient. You will have to have transmission mechanism working, which means liquidity conditions should remain in surplus mode. I believe in the last 2-3 days it is on surplus mode, but it has got to continue in the month of June and July. But you see, monetary policy is one way to ensure that interest rates are brought down, but the passing of those interest rates is a function of government's fiscal whatever borrowings they undertake, and the small savings rate which are very, very high. So those things have to be addressed simultaneously if the rate cut is passed on by the banks to the ultimate users like industry or agriculture or other type of people. You have 35, 25, 50 in my view is only a signaling effect, and unless you have the liquidity, unless you have the transmission mode in proper position, thanks to your getting the small savings rate right and your overall borrowings coming down, and then only you will have an ability to get the rates aligned, the rates in the market with the G-Secs and other rates aligned with our expectation of interest rates for the banks to pass on. So this is a complex situation. So a rate cut alone is not sufficient.
Okay, Mr. Gopalan, if I may ask you, of all of the indicators we've sort of seen, and if you list out the key ones of them, core sector data was pretty disappointing. Slowdown in GVA, of course, as we've seen in the last quarter. Agri growth is a worry, employment data that has come out, auto sales data. Which of these factors do you think is the low-hanging fruit that can be worked on? Which is the most worrying to you?
Well, I don't see any low-hanging fruit at this point in time. If you want to kick the consumption cycle, you are going to pay a price for it, because is there an ability for the economy to absorb that? The potential of the economy is almost close to 7, and if that is not increased, if investment is not going to take place, any amount of pushing through consumption is only going to have negative results. Now, you will have to get into a lot of other things. So, okay, you are now taking care of the vulnerable sections of the population through your PM Kisan, through your pension schemes and those kind of things, MNREGA, you are taking into account all those things to see that the really poverty, below poverty line people are taken care of. But how do you kickstart the functioning of the economy? How do you ensure the capex cycle really picks up? There are a lot of things that are required to be done, and there are a lot of headwinds now we are seeing also. The NBFC problem is there. In my view, that is going to not going to go away. It is going to come and haunt us as we go along. Then you have got problems of trade, external trade. You have got problems of Trump effect, China, those kind of things are also affecting us in a very, very big way. And budgetary side, if you look at it, are the revenues projected appropriately? Are there going to be extra borrowings which are not part of the budget, which will once again ensure that the space for the private sector is far less? These are some of the issues which require to be looked at. There are a number of things which are required to be done. I don't think any one of them can be termed low-hanging fruit, but a lot of things have to be done with great persistence, and it has got to be done in a continuous, sustainable manner. Unless you do all those things, you don't have a magic wand to say that I am going to increase the growth rate today from about 6.8 to 7.5. That's not feasible.
No, absolutely, and one would be very wary of a magic wand like that. because it would raise big questions on data integrity. I've got Maithili as well with us. Essentially, this evening, we're asking how bad it really is in the economy, looking at the vast set of data we've seen in the last few days, whether it's auto sales or it's, of course, GDP growth, core sector data, etc. How truly dismal does it seem to you? And is too much being put by a possible RBI rate cut to be the panacea of the current situation?
Well, two questions that you asked me, Tamanna. First, is it all gloom and doom? No, I don't think it's all gloom and doom. In fact, today we just got some data showing that the May PMI for manufacturing is the highest in 3 months, close to 53%, 52.7%. So that's a good number. It shows that there are signs of recovery. Yes, the data that we've got so far about GDP is not very satisfactory, but remember the annual growth of 6.8% is the lowest in the past 5 years. And if 6.8 is the lowest, then I don't think it's really as bad as people make it out to be. The problem is we've got used to having high rate of growth of 7% and over. So anything less than 7% looks very bad. At the same time, as far as RBI's panacea, the rate cut as a panacea, it never is a panacea, it never was and never will be. A lower rate of interest is just a necessary but not a sufficient condition. Many other things also need to fall in place, but yes, a rate cut is warranted at this time because the RBI had kept monetary policy unduly tight for far too long. Once we have that rate cut, the real rate of interest will come down, and as we've seen capacity utilization move up, I think we will see investment also pick up. So no, it most certainly is not gloom and doom. I think it's important that we don't give in to despair, and luckily for the Modi government, once again we are seeing oil prices have come down back to 60. We're seeing foreigners again investing in the country. So I think we are hopefully on an upward trajectory now.
Shogutta, do you agree with that point of view that Maithili is fairly optimistic that you're back on an upward trajectory? And how will this really happen? Do you need government intervention, policy intervention, or do you see that this is, we're at the bottom of that cycle?
No, it's really difficult to disagree with Maithili's crisp analysis as always. But I completely agree with her. As I was saying before, that it looked pretty bad a couple of months back, but I think there are enough signs now that we are already on an upward trajectory, as Maithili says. But there are some things. One, of course, is the measure of liquidity that needs to come in. We are already seeing surplus liquidity in the last couple of days, so I think that will begin to. But the Reserve Bank should ensure or signal that they are providing adequate liquidity. Maybe even, I mean, it's a difficult exercise, maybe go a little bit towards the side of surplus, structural surplus in liquidity rather than a structural neutral, etc. That's number one. But be that as it may, even if transmission happens, it really takes a long time, as Mr. Gopalan also mentioned. But the point now is that the government needs to figure out some ways in which to actually start spending money. One of the key causes of the slowdown in demand, I believe, was that the government was actually not spending in the last couple of months. That needs to start again. And for that, the government needs resources. As Maithili said, fortunately, I think there is some respite on yields. So even if you front load borrowings a little bit with the presence of rate cuts, etc., I don't think yields will go up too much. They can always cut back on borrowings later on in the year as the pressure rises. But right now, I think they should borrow more. They should try to see if they can get some resources from the Reserve Bank's economic capital. And most important, I think they should now look for ways, non-debt capital receipts. All the NHI projects, etc., they should begin quickly to disinvest into InvITs, etc., that will bring in money, particularly foreign investment money. And these are the measures that should be looked at in quick order now.
Okay, Maithili, talking about increasing spend, and do we have the money is the big question. What do you make of, one of the first key decisions that this government has made of extending the PM Kisan scheme to all farmers? Again, is that the kind of spends we should be seeing at this point?
Well, I think the government really feels at the moment that since they made an electoral promise, they feel they have to live up to it. So I think these are just early days, and hopefully they will not continue down this path, because remember, they haven't exactly defined eligibility. They've said all eligible farmers, and they've also talked about small traders, but we really do not know how exactly they're going to identify the beneficiaries, because one of the things that technology has done and has made it possible for the government to ensure that there is no leakage is that it's much easier to do proper targeted identification. So hopefully that will be the first move that the government doesn't just spend mindlessly, but only to targeted beneficiaries. Along with that, as Saugato mentioned, disinvestment is a readily available opportunity for the government to go in for it now. This is the time when the Sensex, the stock markets, everybody is very gung-ho about things. So if the government were to come into the market with IPOs of some of the blue chip public sector companies, they'd be snapped up. And also remember, June is the month when you're going to see the Bimal Janat committee submit its recommendations. So there again, the RBI might come to its rescue.
Yeah.
And again, June is the end of the financial year for the Reserve Bank of India. So some money coming from the Reserve Bank of India, something from its reserves, some disinvestment, GST numbers are looking up. So overall, I think things are not as bleak as they are made out to be, provided, and I repeat, provided both the government and the Reserve Bank of India play their cards carefully and do not go overboard like the 2008-9 stimulus.
Okay, so two factors to watch out for, and Mr. Gopalan, you talked about NBFCs earlier. We've not discussed that much in this show. I think it's important to come to that in a bit of detail. And the monsoon. Hopefully there will be good monsoons which will take us ahead. But those are the two sort of risk factors that you're seeing?
Immediate risk factors, yes. On NBFCs, as I mentioned to you, there are housing finance companies, there are other NBFCs. Now the problem there is that NBFC problem is not one of liquidity. I think liquidity has started moving in at this point in time. It's a question of to which are the NBFCs to which the lending should take place. So we do not know. The asset quality review at this point in time of the NBFCs will really make it find out who are the ones to whom the money liquidity should flow and who are the ones the liquidity need not have to flow. The second thing is, obviously the asset liability mismatch has to be corrected. That's not an immediate job, but it has got to be done on an ongoing basis. It has got to be done. Unless you do all this, the ability or the confidence with which any lending system can infuse funds into NBFC will be called into question. As far as monsoon is concerned, yes, monsoon has a role to play. Now there are different viewpoints on how the monsoon is likely to be. It has stalled a little bit, but the spatial distribution of monsoon at the time when it is required to be done, that is going to be a very crucial and significant issue at this point in time. And I think there are other things which are required to be done simultaneously along with this is looking into the revenues, the leakage of revenues, getting into GST in position in such a way that the leakage of revenue does not take place. The direct tax code, bringing it as early as possible, because the report is likely to be out sometime in the first quarter. Then the disinvestment, as both Saugata and Maithili mentioned, that is another area where it has got to be an upfront effort to get into that, because I am told that the disinvestment department has a lot of things lined up. It is a time for them to really go forward and then try and do. And secondly, in the expenditure which the budget is going to present, I need to see a real diversion into capital expenditure more. Capital expenditure, as you see, has been going down in numbers, in actual numbers it has been going down. So I need to see a shift towards more capital expenditure as we go along. That is going to be very, very crucial and important thing. There are other issues on infrastructure, on skills, land, labor, taxation, terrorism issues, judicial reforms, regulations, making them easy for people to do business. There are a number of things. All of them have to be simultaneously attacked. Simultaneously, they have got to be worked on with speed and dispatch, so that the benefits of the all these things will occur to the economy in due course of time.
No, absolutely. We've not even talked about the global issues that India may face and not have too much control over. But let me come to the NBFC question in a little bit of detail with Saugata as well, because that seems to be one situation which could quickly escalate into something difficult to handle. Do you think that the steps taken so far seem like they're in the right direction? The government and the authorities are aware of where the situation is going?
Sorry, so if that was for me, I
Yes.
mean, I'm not obviously a NBFC specialist.
Yes, of course, but your view, yes.
It looks as if, yes, so I mean, I think over a period of, this is likely to continue over a period of time. This is an easy resolution is not possible, as Mr. Gopalan said. The regulators conducting AQRs, figuring out the asset qualities, underlying asset qualities. The problem is everything is too connected. I mean, the real estate segment, mutual funds, banks, NBFCs, so untangling all of them, assigning proper risk weights, etc., is likely to take some time. We are waiting tomorrow to see what kind of measures, if any, the Reserve Bank takes in trying to facilitate some refinancing of some of the better NBFCs. And the better NBFCs are anyway getting more money, more funds, and they are lending from whatever we see in the markets. But overall, the total flow of funds from NBFCs is likely to be limited, and we hope there are no systemic issues that arise from the NBFC sector.
Okay, Maithili, I must ask you the very crucial NBFC question as the next sort of, I don't want to exaggerate, but the ticking time bomb which needs to be diffused quickly.
Well, there will be a shakeout in the NBFC sector and there will be some pain. But remember, Tamanna, the reason why the NBFC sector grew so rapidly and much faster than was warranted was because banks were not able to lend. They had neither the capital nor were they in a position to lend, because the kind of pressures that were put on the bank officials, there was this fear all around. So they had neither the capacity nor the willingness to lend. If the government were to recapitalize banks, and I repeat, this is one of the priority areas, the government should recapitalize and recapitalize fully. Then once again banks will begin lending and the share of NBFCs in overall lending will come down. Today they have the situation because banks held back and NBFCs took over that space. NBFCs are never as closely regulated or supervised. It was never envisaged that they should be as closely supervised or regulated, whereas banks are much more closely supervised. So I think very critical issue for the government is to recapitalize the banks, stop this kind of fear mongering and witch hunting of bank officials, and you will see banks lending once again. The share of NBFCs will come down and once again we will see healthy economy and investment take off.
All right, so in that gloom and doom, there is a cause for optimism as well. Let's hope it pans out that way. Thank you so much to all of you for joining us on the show this evening. So yes, it is looking like some worrying signs for the economy, but it's not all bad news. Hopefully, we will see a turn soon. Thanks for joining us on the India Development Debate.